The U.S. Federal Reserve is loosening up its requirements for when it begins to raise interest rates. Before, it had said unemployment had to fall to 6.5%. But with the rate now inching closer to that number, Federal Reserve Chief Janet Yellen and her team are giving more details to her plan. Washington correspondent Daniel Ryntjes is here to share and explain her thoughts.
In the real world, Phil, people want to know how to borrow money. It's part of Janet Yellen's job to tell us how much it's going to cost. But for now, she says money is going to stay cheap. But for how long?
The notion of forward guidance is something that just retired Chairman Ben Bernanke was very keen on. He wanted the markets to know what the rate-setting Federal Open Market Committee was likely to do way in advance, no big surprises. One big plank of that approach was to tell the markets that they wouldn't consider raising the benchmark federal funds rate until the job market was back in the fast lane, when unemployment hit below 6.5%. But now that it's almost there with the current rate at 6.7%, the new Fed chair is scrapping that threshold, mainly, says Yellen, because the unemployment rate doesn't tell the full story.
The FOMC will base its ongoing assessment on a wide range of information, including measures of labor market conditions, indicators of inflation pressures and inflation expectations, and readings on financial developments.
In other words, do what economists always do. Look at all the clues as to what's happening in the real economy. The Fed is continuing to unwind its unusual experiment of asset purchases by reducing them by $10 billion a month. And if things go as planned, they'll stop buying these securities completely before the end of the year. Then, says the Fed, a considerable period will pass before it begins raising interest rates. So what does that mean?
The language that we use in this statement is considerable period. So this is the kind of term it's hard to define, but, probably means something on the order of around 6 months or that type of thing. But, it depends.
It depends, she says, on what financial conditions are like.
So Phil, if all goes to plan, we'll probably see rates rise in about a year's time. But we don't know if it will go as planned. In any case, because inflation's so low, we're not going to see any dramatic rise in interest rates. So it's slowly for Janet Yellen. Phil?